IR35, less of a minefield than it has been in previous years. What is IR35? It's a test the revenue seek to perform to determine whether you're an employed individual or self-employed individual. Now this has been a blurred line for the last 20-25 years because HMRC can't even apply their own rules properly, so for you to determine your own status becomes even harder. But let's look at what the tax side of it is and then look at what this is for you as an individual. If you were deemed to be within IR35, which is the negative side of things, that's deemed to be an ordinary employee. Money that comes into you, whatever shape or form that is all taxed as salary. And you go through the same bands, you know, the 0, 40, 45% tax brackets. If you're deemed inside IR35, you have no control over what you do with your income whatsoever. You're deemed to be employed, deemed to be a standard employee. So what a lot of people tend to do if they're in that position, they'll either revert to being PAYE with an employer, on the payroll for an agency or an employer as a temporary worker, or they could consider using an umbrella facility. Be mindful of what these umbrella facilities sell you. You know, if they're telling you you'll get 80-90% net return, it's all a lie, don't listen. If you're deemed as an employee, you're deemed an employee. You pay tax, doesn't matter whether it's here, now, or another day. So that's being deemed inside IR35. If you're outside IR35, then any fees or revenue that you receive into your company, you have control over. You can determine what you do with that money. Again, within the confines of being within UK law. Don't offshore funds, don't loan it to other people, don't do any crazy things. Let's just focus on IR35 being inside or outside for now. So again, the same scenario here. If you had a limited company and you were deemed outside IR35 and that's inside IR35, outside IR35, you then determine how you draw your funds out of the company. Work with an accountant or a tax advisor just to make sure you're doing the right things here. But you'll typically draw a salary, you'll have expenses, and you'll draw dividends. Now the benefit of that is expenses don't suffer any tax at all that are allowable through the company. Dividends, depending on your tax rate, go from 8.5% to 38.1%, depending on how far up the bands you go. And then salary is then taxed at the prevailing rate that you're normally drawing income at. But what a lot of our clients do is they'll try and suppress the salary down as low as they can, sensibly, to control the PAYE liability. When you're outside IR35, you have to consider a number of other things as well. HMRC have changed the rules with the public sector rules and the private sector rules over 2020 through to 2022. It's not as easy just to say, yep, I'm outside IR35 anymore. It used to be 10, 15, 20 years ago, and you could just carte blanche, I'm outside IR35. Not as easy as that now. So what you have to do to try and show and demonstrate that you're outside IR35 is look at the CEST tool. So this is the self-assessment tool HMRC have. Go online, fill in the details. It isn't micromanaged, it doesn't have an algorithm. They can't check whether you've done it or not done it. But it just gives you a little screenshot at the end of it to say inside, outside. And just do a screen dump of that. Keep it on your file. So if ever HMRC do come knocking, you can say, I did one thing. The second thing you should do is an SDS statement, status determination statement. Depending on who you're working with, your client may elect to do that themselves, or you may be forced to do it or choose to do it. A status determination statement is looking to sort of build upon the CEST tool, looking at what really drove you to say that you're outside IR35. Do you use your own equipment? Do you work from home? Do you have no control over you? Do you sort of tap in and tap out a bit like an Oyster card and work when you choose and how you choose? If you have completely free reign of your working environment, all the things that you do, like a real freelancer or somebody who's directly controlling their own business, then you should be able to trade outside IR35. But again, having that evidence is key. You can't just these days sit there and have that determination on your own back and hope that nobody will come and look at you. If HMRC disagree with your interpretation of the rules, and often they can do, they will seek to look at the difference between what salary you've had versus the strategy you've had here. So they've got to try and prove a material advantage to the taxpayer to make sure that these hasn't been too wildly varied. They have to prove that you're a disguised employee. So have to prove that your thought process behind here has been wrong, the contract's wrong, the determination's wrong, and even your own printout from their own website's been wrong. Then they've got to materially find a financial difference. In order to do that, they've got to look at the books and all of the accounts and everything that you've gone through. What we always recommend is draw a sensibly low salary. Don't go below the national living wage. There's no point. You're paying marginally less tax, but again, you're putting your head above the parapet. There's no point. Only claim expenses that you know you can hang your hat on. Don't put your 90-inch plasma screen through. Put your iPad, put your laptop through, and draw dividends sensibly. Don't just distribute dividends to 10 members of your family because you know you're not going to pay any tax on it. Controlled, sensible planning helps you stay on the right side of IR35 and trading in a way that helps you keep more money. That's IR35.